Imagine this for a moment. You wake up, check the news, and every headline is saying the same thing. Oil markets are unstable, governments are holding emergency meetings, analysts are warning about a potential global crisis. And at the center of all this tension is one narrow strip of water, the Strait of Hormuz. It doesn't look like much on a map, just a thin passage between landmasses, but every single day, roughly 20% of the world's oil flows through it. That makes it one of the most critical choke points in the global economy. So naturally, the story we hear is simple. If something goes wrong here, the entire world feels it. And on the surface, that story makes sense. But it's also incomplete. Because what's really happening isn't just a crisis, it's a shift. And more importantly, it's not affecting everyone the same way. That's the part most people miss. We tend to think of oil shocks as global events that hit all economies equally, but history shows that's not how it works. Oil shocks are asymmetrical. They create winners and losers at the same time. While some countries struggle, others quietly benefit. To understand why, you have to look at how the world has changed, especially over the last 2 decades. There was a time when the United States was heavily dependent on foreign oil. Not long ago, around 60% of its petroleum consumption came from imports. So whenever global supply was disrupted, the effect was immediate. Prices surged, inflation followed, and economic growth slowed. It was a direct, almost predictable chain reaction. But that version of the world doesn't exist anymore. Over the past 20 years, new technologies, particularly shale drilling, transformed the energy landscape. The US unlocked massive domestic reserves and dramatically increased production. And today, it's not just less dependent on foreign oil, it's actually the largest oil producer in the world. That changes everything. Because now, when global oil prices rise, it doesn't just hurt the US economy, it also benefits parts of it. Higher prices mean higher revenues for energy companies, more activity in the oil sector, and increased exports. So the same event that creates panic globally can at the same time act as a boost for certain parts of the American economy. Now, compare that to what's happening in Asia. Most of the oil flowing through the Strait of Hormuz isn't heading to the United States, it's going east, to countries like China, India, Japan, and South Korea. Together, these economies account for the majority of demand from that region. And here's where the difference becomes critical. For the US, a disruption in oil supply is mostly a price issue. Oil is globally priced, so if supply tightens anywhere, prices rise everywhere. That creates inflation pressure, but it's still manageable. For Asia, it's not just about price, it's about access. And that's a completely different problem. Higher prices slow an economy down, but losing access to energy can bring parts of it to a halt. Factories can't run, supply chains break, and production slows. It's no longer just a financial issue, it becomes a structural one. Same event, completely different consequences. And this is where the narrative shifts. Because once you understand that oil shocks don't hit everyone equally, you start to see what's really happening. This isn't just a crisis unfolding in real time, it's a rebalancing of economic pressure. When supply tightens and prices rise, the countries that produce energy gain leverage. And right now, the United States happens to be in that position. But oil is only part of the story. There's another layer that's often overlooked: natural gas. The Middle East isn't just a major oil supplier, it's also one of the largest exporters of liquefied natural gas. And just like oil, a significant portion of that gas flows through the Strait of Hormuz. If that route is disrupted, it doesn't just affect oil markets, it tightens gas markets too. And once again, the United States plays a key role. Over the past decade, the US has quietly become one of the world's largest exporters of liquefied natural gas. So when global supply becomes uncertain, demand shifts, countries look for alternative suppliers, and that creates opportunity for exporters who can step in. This is how crises often work in global markets. Scarcity doesn't just create risk, it creates opportunity. Some regions lose supply, others gain influence. And that brings us to the most important question. If some countries benefit, then who is most exposed? The answer is complicated, but one country stands out: China. China is the world's largest importer of oil. Its economy depends heavily on a constant flow of energy to sustain manufacturing, exports, and industrial production. Millions of barrels per day are needed to keep everything running smoothly, and a large portion of that supply comes through the Strait of Hormuz. Now, to be fair, China isn't unaware of this risk. Over the years, it has taken steps to reduce its exposure. It has diversified its suppliers, increased imports from countries like Russia and Brazil, and built strategic reserves to buffer against short-term disruptions. But those measures don't eliminate the risk. They only delay it. In the short term, China can absorb a shock. In the medium term, it can rely on reserves. But if disruptions last long enough, the pressure begins to build. And that's when things change. Because China's economy isn't just large, it's energy intensive. Manufacturing, exports, infrastructure, all of it depends on steady energy input. If that flow slows, the impact spreads across the entire system. What starts as an energy issue can quickly become an economic one. And this is where the story becomes more than just about oil. Because if you zoom out, something about the timing feels strategic. As tensions around the Strait of Hormuz have increased, global trade relationships have also been shifting. The relationship between the United States and China has been under pressure for years. Tariffs, technology restrictions, supply chain changes. These aren't isolated events, they're part of a broader pattern. And in that context, energy becomes more than just a commodity, it becomes a tool. Because in global economics, leverage often comes from pressure. And pressure can come from many places: financial markets, trade policies, or even energy supply. If one country can absorb a shock while another struggles with it, the shock itself becomes a form of leverage. And that's what makes this situation so interesting. The Strait of Hormuz isn't just a passage for oil, it's a pressure point in the global system, a place where geography, economics, and geopolitics all intersect. So while the headlines focus on crisis, the deeper story is about positioning. Who can handle the disruption? Who benefits from higher prices? Who faces real structural risk? Because once you start asking those questions, the narrative changes. It's no longer just about instability in the Middle East. It's about how that instability reshapes global power. And that's the part most people don't see. Because sometimes what looks like a global crisis on the surface is actually a redistribution of advantage underneath. And in a world where energy still powers everything, control over supply doesn't just influence markets, it influences outcomes.